Alibaba is a popular trading vehicle for traders here at our prop firm, and as you probably know, Baba's stock has lost almost half of its value this year. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our desk like to use option strategies to take advantage of bearish moves on stocks like Baba, and they have the expertise to understand how to structure those trades with the potential of incredible rewards for very little risk. So if you're interested in how to structure a high reward, low risk trade to play Baba's continued weakness this year, then stick around because I think you're going to find this intriguing. Hi, I'm Seth Freuberg. I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so the trend is the trend until it's not, is a popular trading expression that top flight traders follow, and it doesn't take a doctoral degree in chart reading to look at this chart and realize that Baba is in a downtrend, and it wouldn't be crazy to assume that this downtrend will continue until further notice, as it has for the past 8 months. And so it could be a reasonable thesis to assume that it will break down through its low of the year down at 179 and keep moving downwards. And so there's a very interesting option strategy that you can employ in these cases, which gives you an unusually good risk-reward trade-off that we'll teach you in a minute, which pays off in a big way if you're right and has little downside if you're wrong. Now, we're going to assume that most of you watching this video know how put options on stocks work, but for those who don't, we're going to do a really quick summary of how they work and jump right back into teaching you this strategy. Okay, so what's known as a put option on a stock entitles the buyer of that option to sell 100 shares of his stock that he owns at a certain price called the strike price of that put option, regardless of what price the stock's actually trading at when he exercises that right. The buyer of the put option pays what's called a premium to the seller of the option because the seller of the option is actually taking the risk that the stock will go way below the strike price of that put option, in which case the buyer can exercise his option and force the put seller to buy his shares at the put option strike price, which is higher than where the market's trading, causing the seller's account to get marked down. So even if the market goes way below the strike price of the put option, the buyer of that put has the right to sell 100 shares of that stock at the strike price of that put. So he'll get a way above the market price for those shares by virtue of owning that put. And so the premium of the put option reflects the risk that the market thinks the put seller has that the shares will be going much lower than the strike price of that put. So all other things being equal, when a stock price goes down, the price of a put option for that stock will go up because the put seller's chances of taking a loss because the market has blown through his strike price gets larger as the stock's price continues to drop. Okay, so now let's move out to an options chain that expires about a month out from August 13th, specifically the September 10th options chain, which expires about a month later. And with Baba trading at 188 that day, let's take a look at what would happen if we bought 5 of the 175 puts, sold 5 of the 170 puts, then moved further down the options chain and sold 5 of the 150 puts, and finally bought 5 of the 145 puts. So that combination of a long put position below the market followed by 2 short positions lower than that and 1 more long position below the 2 short put positions, that entire structure is an option strategy known as a put condor to options traders. Now, before we get into why a put condor is a really solid, low risk, high reward way of expressing your thesis of the continuation of a bearish trend on a stock, I'd like to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so let's first break down what's happened here from a cash flow standpoint so you'll understand the anatomy of this trade. So let's start with that 175 put, and you'll see that it cost us $2.75. But remember, each option represents 100 shares of stock, and so you multiply that by 100, and we bought 5 of those. So the total cost of those 175 puts was actually $1,375. However, we then turn around, sell 5 of those 170 puts for $1.97, receiving cash, as you can see from the calculation, in the amount of $985. We also sell the 150 puts, receiving $355 for those 5, and finally we buy the 145 puts for a total of $320. And so our total risk on the trade, the worst case scenario, the most we can lose, is $355. Okay, so let's move forward to the last day in August, August 31st, and as you can see, BABA has indeed broken down below that 179 level and is now trading at 166. So let's take a look at the value of the put condor as of August 31st, and as you can see, the value of the 175 put, which was originally 275, has now skyrocketed to 965. And the 170, those puts have also shot up to 607 in value. While the 150 and 145 options have lost value down to 68 cents and 48 cents respectively, because the options are set to expire now in only 11 days, and for them to have any value, another substantial drop will be necessary, and the stock is just running out of time to accomplish that, and so the value of those have dropped, a phenomenon which options traders call time decay. So now if we do the math on the value of this condor, if we wanted to close it today, it would look like this. And so to close a put condor, you simply reverse the transaction that you originally made to enter the trade. And so you sell off the puts you bought and you buy back the puts you sold to close that position. So specifically, you can see that by selling those 175 puts for $965, we brought in $4,825, but we then had to buy back the 170 and 150 puts to close out those short put positions, which cost us $3,035 and $340 respectively. And finally, we received $240 for selling off those 145 puts that we owned, bringing the grand total value to $1,690. And we then subtract out the original $355 cost, resulting in a final profit on the trade of $1,335, which is more than 3 times greater than the risk of the trade. Now, it's important to understand one more thing about this trade. Let's just say that BABA closes on the day these options expire at, say, 160. Let's analyze the value of each of these options if that were the closing price on September 11th, the expiration day of these options. Well, the 175 puts are 15 points above the closing price of BABA. So what that means is that if you owned BABA shares worth 160 and you had the right to sell 500 of those for 175, then that put would have a value of $15 per share for you, for a total value for the 5 puts, which translates into 500 shares of $7,500. So the 5 puts have a value of $7,500, and with that same reasoning, the 170 puts, which are 10 points above the market, for 500 shares would be worth $5,000. But remember, you're short those 5 puts, so you'd be the one buying those shares at $10 more than they're worth. So that would mark your account down by $5,000. So that would represent a negative $5,000 in value for those puts. Now, furthermore, the 150 and 145 puts have no value because no one's going to sell their shares worth 160 for either 150 or 145, so they both expire with no value. And so when you add the whole thing up, the condor would have a final value of $2,500, which if you subtract out its original cost would yield a profit of $2,145, which is more than 6 times the original cost of the put condor. And here's the most interesting part. You see, at any price below 170 and above 150 on options expiration day, the condor would be worth $2,500. Why? Because the 150 and 145 puts still expire worthless at any of those prices, whereas both the 175 and the 170 would have some value, and just like in this example, the value will always net out to $2,500 because the value of the 175 will always be $5 per share greater than the value of the 170s on expiration day if you think about it carefully. And so over that entire range of 150 to 170, you have the opportunity of a risk-reward scenario of over 6 to 1 on a fairly obvious bearish trade like this. And so what I'd like you to take away from today's video is that there are low-risk ways of making many multiples of your risk in the form of upside potential simply by selecting a range of prices for a stock in the near future, and then for bearish trades like this one, creating a put condor with very little risk but a really attractive reward potential over a fairly wide range of outcomes. This is the kind of thing that experienced options traders know quickly and intuitively how to do and can create excellent risk-reward trade-off situations for themselves once they learn the basics of these kinds of strategies and have a little experience implementing them. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.